You might have heard in the news about firms issuing large stock buyback programs. They'll often announce and say, okay, we're going to buy back $30 million of our own stock. But that begs the question of, well, why would they do this? Well, what is going on here? Why would a firm repurchase its own shares? What is going on here? Well, one reason might be that the firm needs the shares. Maybe it needs needs them available for some stock option programs that it gave to its executives. So they're going to need some stock on hand in case the executives decide to cash in, those options. And so the company decides, oh well, we need to make sure we got 500,000 shares, and we'll go ahead and buy them. So that's one thing. Another thing, it might be that the firm decides, oh well, we want to go and do an acquisition. And we want to use our own shares. We're going to, instead of issuing more shares and diluting the ones that are currently out there, we're going to finance this acquisition with shares, but we're going to go and buy back some shares and use those. So these are a couple reasons, but there are some other reasons that are kind of more strategic. The firm's got kind of maybe a real deep plan with what it's doing. So let's think about this. One is the firm might be trying to send some kind of signal to the market that the firm is undervalued. So you got to remember that the firm has inside information that an investor does not have. Now, investors can go and do research and so forth, but ultimately they don't know everything that's going on in the firm. They don't know all the projects. The firm, the people within the firm, they know. They have all the information. They know they have a pretty good idea compared to an investor what's going to happen in the future. They have more knowledge inside the firm than exists outside the firm. So if the firm, and by the firm I mean like the officers of the firm, if they're actually saying, okay, well, we need to go out and have the firm purchase some of its own shares, well, that's a signal, because you're giving up assets, you're giving up cash. So that makes it kind of a credible signal. Right? People will believe it. You're sacrificing assets. You're giving up cash because you have some knowledge about the future that you believe is positive. So if you thought things were terrible, if you thought things were just awful at the firm, you wouldn't be sending this signal. You wouldn't be saying, oh, let's give up our cash and let's go buy some stock. You absolutely wouldn't be doing that. So you're sending kind of this credible signal that the future is bright, that there's some projects or something that there's a reason to believe in the firm. So another thing is you create a price floor. So if the stock is, here's the stock, and the stock is just declining, it's just going down and down, and then, now you might even not believe it's undervalued or whatever. Now this might be a different thing. You just say, well, I want to create some kind of floor here. I want to create some kind of floor. I'm going to go and just start buying up shares here. And what you're doing is you're creating demand. You're infusing your own demand, basically. When you're buying shares, well, then you're demanding shares. And what happens when you have a huge influx of demand? Well, when you have a huge influx of demand, typically price will go up, or at least stabilize. What you're trying to do is you've got this downward trend, and you want to, at a minimum, just stabilize it. You want it to just go like that, at least that, maybe even start going up. So what you're trying to do is create some demand. You're buying shares and creating demand, and just kind of say, okay, well, we need to stabilize the price of this stock. And another reason that you might a firm might repurchase its own shares has to do more with the tax rates. And tax rates, let's say the tax rates for dividends, are really high, just ridiculously high. Dividends are just high. Now, you might be thinking, what does that have to do with a share repurchase? Well, think of a share repurchase as a distribution to shareholders, right? You're distributing cash to shareholders. And it's different than a dividend, I guess, technically, but if you just think of it as that distribution to shareholders, well, then it's not all that different than a dividend. So if dividend tax rates are really high, then it might be that if you do a distribution via a share repurchase, that ultimately the shareholders end up getting to keep more of the money. So the shareholders would retain more money, and the shareholders would benefit. So shareholders retain more. Potentially, it depends what the tax rates are, and of course the management will look into that and But that's one reason you might repurchase shares. And another reason, and this is kind of more, maybe a little more artificial than some of the reasons up here, but you can boost earnings per share by reducing the number of shares outstanding. So if you remember how earnings per share is calculated, you've got earnings per share is the net income minus the preferred dividends, which I'll just abbreviate there, divided by the weighted average of common shares outstanding, which would just be CSO. So if we can if we can buy up some of the shares, well, now those shares are no longer outstanding, right? Shares are no longer outstanding if the firm repurchases them. So if we can go ahead and decrease that, and then this up here remains constant, then if this decreases, then what's going to happen? Well, the earnings per share will go up. So let's just work through an example here, so we can kind of get out of the abstract and put some numbers to it. So let's say on our example, we've got net income of $200, and the common shares outstanding, I'll just say CSO, let's say that's 1,000, and then so under that kind of regime, the EPS is going to be 20 cents a share, right? So now let's take this same situation. So let's say again the net income is $200, but now let's say something different happens here. Now the firm buys 200 shares back. Okay, so now what's going to happen is that common shares outstanding, that CSO, is going to decrease by 200. So now that's 800. So now we've got this denominator has declined. Okay, so now it's 800 instead of 1,000. So what's going to happen here? Well, let's just compute this, and we're assuming there's no preferred dividends here. But earnings per share is now going to be 25 cents a share. So now if you're a shareholder, of course you're happy with that. So you can kind of pump up, you can kind of play with your earnings per share by kind of controlling, influencing the common shares outstanding. Now a criticism of this, why this someone might say, well, this isn't a very good idea, or this doesn't make a whole lot of sense for shareholders, is that you could have instead, whatever money used to buy back those shares, that could have instead been put into some project, right? So if let's say that would cost $1 million to buy back those shares. Well, that $1 million, maybe there was some project here. There was some project that could have made money. And maybe the amount of money made from that project would have boosted net income, and that boost in net income might have exceeded so what happened basically from this earnings per share game, right? For if we think of the net income, so basically think of it like this. This is a little abstract here, but the net income increases, and then instead of the denominator decreasing, we're just increasing the numerator. Now that also increases earnings per share. So basically these people would say, look, instead of just gaming the system here and decreasing the denominator by just buying shares, why don't you instead use that money to increase the numerator, increase the net income, increase the earnings by doing this project, and then that'll increase the earnings per share. So you didn't really game the system. Now you actually use that money to create value.